years because I've been doing it for 20, of course. But this is a concept that was shared with me by way of institutional traders that view the market like this. Okay, and they employ this information, and I'm more or less sharing it without their blessing. So let's just understand that what we're sharing here isn't in a book. It's not anything like that. It's not for sale anywhere, but I am giving it to you. So there you go. I want you to see there is a range, okay, that's being discovered, maybe for the first time for some of you, right here. And I want you to, for the moment, take your eyes away from that. Okay, and what this is showing is the range between 1900 GMT to 0 GMT. Okay, every day, generally, you'll see a very tight consolidation like that between those times. What's going on there is what's going on there during that time is the the dealers are looking at what's existing in the marketplace. In other words, where are all the open orders? Where's the float? What is the general consensus of the marketplace? And they're going to use this information going into London Open. Now, I know some of you are going to argue, well, Wellington is the new day. Well, it may be new day to you, but as it relates to the higher low of the marketplace for the 24-hour day, um, it doesn't mean much. It's too early in the day. But in here, when we're looking at price like this, we can fragment the day utilizing the central bank dealers range. And what this is doing is gives us areas of overbought, oversold without the utilization of price indicators. And what's happening here is this is the overall range, okay? And if we're bullish, okay, if we're bullish, we would anticipate what taking place going into the new day. We want to see a move going lower. Why? Because we learned that power 3 is we want to see the opening price and below it be our area where we like to do our hunting for longs. Okay, price does in fact, out of this consolidation, sweep below this low. It does it right here. Okay, it goes down how far? 2 standard deviations, just a little bit, one wick went a little bit below it, but you're taking the range that's between 1900 GMT and 0 GMT, and you're replicating that going down. Okay, I could go one more, but generally 3 deviations higher or lower, that's about the standard that the market will move, unless it's a very extrapolated move that's news driven. Okay, but in here, if we're looking to be a buyer down here, okay, how long can we hold on to that position? How long will they view intraday that range before it would cap it? Well, once we get on the other side of the central bank dealers range, we have 1 standard deviation, 2 standard deviations, 3. If I extend this out, right there is where they made the high of the day. And then what does it do? It goes into consolidation. Okay, you see that? So what we use the central bank dealers range for is a measure of true overbought or oversold, and we look for areas to build the case for entry and exit, not just simply, are we overbought or oversold on a stochastic or RSI, but more importantly, in terms of where we're at in this range. Now, what is going on here that's so important? Again, they're looking at what is existing in the marketplace right now. Is there a lot of buyers above this or a lot of sellers below this? Based on that knowledge that we're never going to have. We're never going to have that real knowledge of what they can see, okay, or whatever the real order book is. And I'm not talking about your dealers or your brokers. I'm talking about the central bank level. They see all that stuff. They know what's out there, Okay, and you can argue with me all you want. I don't care what you believe. Okay, when you get my result, then you can tell me something different. But right now, you're in my class. Okay, so there's a little dose of ego for you guys that want to troll. The bottom line is this: if we're in consolidation like this, we anticipate a move down for buys, and we indicate that by a Judas swing. Okay, going into a time of day. Well, the low of the day is formed right at the beginning of our blue line, which indicates the London Open kill zone. Boom, there's your buy. Okay. ICT reflection, low to high, pull that down. You'll get this exactly on the low. I'm not going to do it to clear out the chart, but you can do that on your own. For now, just understand that the central bank dealers range, okay, is a concept that we employ, and we will be doing more research and applications rather in the specifics about how I trade on swing trading, short-term trading, and intraday trading. Okay, and we'll be able to utilize that information much more specifically. But for now, just understand that the central bank dealers range gives us an overbought, oversold measure that's highly effective and never requires any reaching for an oscillator of any kind, and it's very precise. Just understand also that generally 3 standard deviations is a maximum, and generally you'll see that it's 1 standard deviation. Not in this case, here's 2, but I use this example to give it to you. Many times it's just 1 standard deviation where it drops down for the Judas, and then it'll make the low and then rally up and then do the standard deviations above the central bank dealers range to give us an indication of how far higher it will move based on that buy, and just reverse it for sells. Okay. Okay, folks.